Banking on the digital space. Why the analog platform is no longer appealing for Stanbic Bank. Good evening. Many thanks for joining us. This is The Trading Bell. My name is O'Brien Kimani. Later on, I'll be talking to Samuel Gishohi. He's the Business Development Manager at NIC Securities. And I'll be finding out from him how has the market behaved since the launch of Akiba and what should we expect going forward. This is The Trading Bell, but for now, let's get down with Philip Odera. He's the Chief Executive Officer of Stanbic Bank, and I'll be finding out from him why they are so confident that the digital space is the future of banking in Kenya. Philip.
Yeah.
Thank you very much for joining us on The Trading Bell.
Yeah.
Please.
Thank you.
Take your position.
All right. Yeah.
Basically, first of all, I want to find out from you.
Right.
You've been in the banking industry for now close to 2 decades.
Yes.
And you have operated in Uganda, Tanzania,
Yes.
Malawi. Yeah. Now you're in Kenya. Yeah. What conclusions do you draw when you look at the Kenyan banking industry that we are operating in now?
Well, first of all, and it's interesting that you've mentioned the countries that I've operated in. And indeed, I've operated in quite a number of countries on that. One of the things that we certainly take for granted is the fact that this market is actually far, far more developed than other markets. And indeed, if we just had more Kenyans, by the way, going out to other markets and seeing how those markets operate, and seeing the fact that those markets are not as developed as we are, they'd be really, really shocked. So banking in Kenya has actually come a long way. And I can attest to that. When I compare that to the number of other markets that I've operated in, it's come a long way.
And are we seeing the worst that we have ever seen? Operating in a regime whereby interest charged is controlled, the economy is facing various headwinds from elections to political jitters. Is this the worst that we have ever seen?
You know, it's interesting you say that, and it's interesting you talk about, is it the worst that we've ever seen? Because all markets evolve. And as far as I'm concerned, this is just part and parcel of an evolution that is taking place. If you went back about 15, 20 years ago and asked people, and I'm sure there was something or some activity that was taking place at the time that we looked at and we said, my goodness me, we've never seen anything of the sort before. This is part of an evolution that's taking place. The critical thing, as far as I'm concerned, is will we overcome a number of these challenges? And I think we will. I think we have got a robustness in the market. I think we have got some sustainability in the market. I think we've got a market that is fundamentally strong. It may have a few sort of knocks here and there that come from time to time, but fundamentally a strong market. And it was proved over time that it can weather whatever storms. It's a challenge when you're in the middle of the storm, because you look through and say, my goodness me, when does this end? When you look at it post the event, you say, that was a tough time, but you know what? We've come out stronger. And we'll come out much better. And I think that's where we are.
And I think it's very interesting you're talking about STEM. And it's very true. We are going through a very volatile phase. And I'm reminded by a quote, I think it was Winston Churchill, who said, are you going through storm? Keep on going. I want to find out from you. Stanbic Bank.
Right.
You know, you're very strong in corporate banking.
Indeed.
And we know for sure that the personal banking segment of the market is where everybody is going to. Are you likely to change your focus and try to go heavy into personal banking?
I think that's a great question that you put forward, and I'll respond to it in the following way. Yes, we've been strong in the corporate sector, and we continue to be strong as a corporate bank. We also, on the other hand, have had a foray into the personal market, as you call it. The challenge has always been one of how do you play sensibly in that space? Now, others don't go into that space for the sake of going into it. Are you going to that space because you're adding some value to it? Now, previous to this, the way that value was perceived was go out there and put out some more what we call brick and mortar, as many branches as possible out there, and be seen and be visible in that regard. That's one strategy, and I don't say that it's wrong, but that is one strategy. But that was also not a strategy that we felt worked for us. Where we think it makes more sense is to use the technology that is available to go out to touch and to go out and reach that personal market. That's what we think is a more relevant way to. That means now for us, from a personal market point of view, how do you talk about and how do you create convenience for your customers? We've got many customers, by the way, who want to deal with us and want to deal with us from a point of view of convenience. Mm-hmm. So can they reach us on the internet? Can they reach us on mobile banking? Can they use their phones? Can they use their laptops? That's really what they're interested in. Mm-hmm. Now, when it gravitates towards that kind of, it means that from where we are sitting, we feel we are very comfortable playing in that space because the technology is an area which we can manage and manage pretty well. And if we do that, we can begin now to go out into the personal market mm-hmm. and add value.
So it's like, you have a strategic forecast towards venturing and going heavy into the digital space.
And let's face it, digital is where it's happening. Digital is the future. And if you step back a bit and look at the demographics of any country, and Kenya in particular, and see how many people we have and their age group, and find a lot of people who are tech savvy who are now coming more and more into the workforce, they have very little interest, many of them very little interest mm-hmm. in coming into a mainstream branch. They're not interested. What they want to have use of is financial services. They're not necessarily interested in having to come into a branch to access those financial services. Mm-hmm. So if we can provide services to them in a convenient manner, that's what they're looking for. That's value add for them. That they're willing to pay for. What they're not interested in is coming and standing in long queue somewhere. They don't subscribe to that. That's what is making Digi so exciting. That's what is making Digi so relevant in the time that we have.
Mm-hmm. And we saw a marginal drop in your profit for the year 2016. I want you to tell us how much of that drop do you credit to the South Sudan market and the interest capping rate law?
Well, you've mentioned two critically important things. One is the interest rate capping law that came into place September last year, 2016. And you've mentioned something else, which is South Sudan and the challenges with South Sudan. I think from an interest rate capping point of view, it clearly there was a slowdown in economic activity that followed the law that was propagated. That clearly has been the case. I say slowdown as opposed to no movement, but there's been a slowdown in that regard. South Sudan, quite clearly, some challenges. I think our business there did well, in fact did reasonably well. The challenge we had is South Sudan became a hyperinflationary environment, and consequently we had to now recognize in our books the effects of having a hyperinflationary environment. So that was brought into book. So if you look at our activities in South Sudan, they're actually proceeding well. If you look at what we were doing, it was actually, and it remains a profitable business. Mm-hmm. But in accounting terms, obviously, in having to recognize the impact, and it's quite a significant one, the impact of hyperinflation, that then becomes something that is brought onto our books because South Sudan operates as a branch of Kenya. Mm-hmm. So that affects the Kenya books. And that's what you saw translating into that marginal difference in the performance.
And the other day, I think it was last week but one, we saw your mother company, that is Standard Bank of South Africa, saying that they are likely to review some of the markets that they operate in. And I was left wondering, could South Sudan be one of the markets whereby you're likely to look back and say, I don't think we need to be here this time?
I'm not sure that in reviewing that's the context. So when we put that, more than likely when we refer to reviews is really in terms of the appropriateness of the business that we are conducting in the particular environment. So if, for example, we are in one environment and we found that our strategy was the following, to do certain things in a certain manner, and we find the dynamics of the economy or the environment have changed materially since we actually entered there, then we would be reviewing to say, is that a strategy that we should still continue with? Should we continue in the same manner? Is the execution of the strategy going to be conducted in the same manner? Or do we change to something else and say, this other thing is now far more relevant for the environment? I think that's the context in which we will be looking to review. We certainly don't have a history of withdrawing from markets.
But history is created. Yeah. I want to hear from you. I mean, when you went into South Sudan market, I mean, there was peace. You know, there was serious prospect for economic growth and economic offtake, and then instability kicked in, and even now there is no hope that, there are no signs that stability is going to come back to South Sudan anytime soon, with all the grandstanding between the two parties. Are you likely to get to a point whereby you have to say, I think we did we made a right decision then, but I think our stay here at this point is not making sense?
Well, to start with, we're not making losses.
But you're not making as good money as you were expecting.
In South Sudan, we're not making losses. But then again, that's the context that I was referring to, and that is what happens when you go into an environment and the environment actually changes from what you originally envisioned. Do you continue in the same path, in the same way, or do you adjust your business to actually suit the new circumstances? And that's what we have chosen to do. And typically, that's how we as a bank respond to issues and the challenges on the ground. We'd like to believe that typically in most markets, we're there for the long term. And in order to be there for the long term, you must have an ability to adjust to. I had an opportunity a couple of weeks ago to be in South Sudan and to meet with different parties, and I do that as often as possible to get a sense of what is it like on the ground, what are the issues and so forth, both government parties as well as the private sector, and there are private sector players over there, to get a sense what are their views and how do they feel about the future, how comfortable are they about the activities in South Sudan. And I must say, by the way, it left me encouraged that whilst there has been turbulence to a large degree, I think there is also the beginnings of a clear realization that things must change in order for the future of that country to be sustained. If they don't do that, there's a problem. But I think I was encouraged to find that that view is now beginning to prevail.
Finally, because we have to wind up, we have seen, the annual economic survey report by Kenya National Bureau of Statistics, whereby they're saying that there was some mild contraction, actually not mild, because there was mild contraction in the banking and financing sector, whereby the sector grew by around 6.3% against 9 point something percent last year. And a lot of these was as a result of the banking amendment law. In your position now, do you think that it is time that the government sit down with the banking industry and say, look here, I think we made a mistake, we need to check something and put it into fix before it gets out of control?
I think at the end of the day, we all need to sit down and review the way forward. Let's go back to what actually prompted this law to come into place. And it was really more the issue of the fact that the interest rates, the lending rates to customers were actually viewed as being too high. And I think there's actually an agreement on both sides that the rates should actually come down. There was an agreement on all sides of that. The challenges that we had were on the how. How do you actually bring those rates down? And that one route, which was tried, which was the regulated route, in that one, regulate the rates down. Of course, as you can see, you've all seen, and we have all seen, has proved to have its own challenges. I think it's time that we all got back to the drawing table and then look and say, if that doesn't work, what else works and how else should we actually work? So that at the end of the day, credit flows where it should flow. And if we do that and we do that successfully, we should be able to get back on our feet, all of us.
Very well. Thank you very much, Philip, for joining us here.
Thank you.
Very good. Philip Odera is the Chief Executive Officer of Stanbic Bank, joining us here on the Trading Bell so that we can get to understand what is happening in the banking industry in Kenya to remain relevant and afloat in this competitive industry. You're watching the Trading Bell. You don't need to go anywhere. Stay right here. We are back shortly. And there you have the figures for the losers and gainers in the last 1 week. Sam Gishohi is the Business Development Manager at the NIC Capital. He's joining us here to help us put these figures into perspective. Thank you very much indeed, Sam, for joining us. Now, when you look at the four indices of the market, they are all flat out, except for the NSE 20 share index. What would you attribute this to?
Well, I think we're seeing a bit of profit taking. Considering that some of the blue chips, if you look at the bottom, we hit a 9-year bottom around the 31st of January. And since then, the likes of KCB have done over 40%. I think COP over 27% gain on their capital gain. And so we are starting to see people who bought at the bottom have a sort of level where they can take profit, and that can sort of give us a level where we feel that the market has also sort of stagnated for a bit. But again, we are approaching their books closures for the dividends, which again will usually come with a spike in their share prices. And then immediately the books close, there will be a tendency for the share price to either stagnate for a while or go down by the amount of the dividend if the market is as efficient as we expect it to be. So then again, it is usually an issue of how much are they paying in dividends, what are investors seeing going forward, what did the results season bring out, and what are the expectations going forward. Yes.
And almost 2 weeks since the Emakiba was listed, people are asking what has been the impact of the Emakiba bond on the market, because we cannot feel it actually.
Well, I think Emakiba, in terms of the volume of the amount of money that was being raised, which was 150 million, was not money that would really shake the market. What I think Emakiba is in terms of vis-a-vis the market is that it is a game changer. It is the first product that is allowing people, at the mashinani level to access the bonds market. 3,000 shillings is quite affordable, and that is actually, a very innovative product, which will allow people to find a platform in which they can invest with, in what was previously thought to be, a preserve of the banks or the elite, and now they can actually access that. Very much as what, say, M-Shwari or M-Pesa, those products give to the banking industry and to the money transfer industry, which is accessibility and the ease of transaction. And that is really a game changer for Kenya, being a first in the world.
And now, going forward, when you look at the top gainers, do you expect this chart to remain the same?
Not really. I think I would be looking, as an investor, I would be looking at those companies whose books closures are coming up. For example, KCB, we noticed a spike today to 34 shillings. Their books closure is on the 24th, which means that now dividend seekers will be wanting to opt in before the books close, because once the books close, then you won't get the 3 shilling dividend. However, it would be important to note that it has already rallied from 23.25 on the 31st of January to 34 shillings, which is a very good gain for those who had already gotten it earlier on. So again, everybody has their own points of entry and exit, but there's those dividend seekers, and most Kenyan investors tend to be very dividend oriented.
And finally, on the top loser table, we have some companies which have become very prominent on this one. Do you expect a radical change in the top losers table?
Not necessarily. I think our market is very sophisticated now, and there's a lot of research going into the investor decisions. And so you'll find most of the companies that are sitting on the loser board will tend to have either fundamental issues or issues where investors are expecting them not to do well in terms of profitability, or there is policy issues that might affect them going forward, particularly in an election year. And I think you'll notice that there is some agriculturals in there. You'll find some of them in the sugar industry, which again tends to be very, very politically exposed, because markets are also affected by externalities. And so companies which have that political exposure, or the drought, for example, will affect the agriculturals, will also tend to have an effect on the sentiment of investors.
Thank you very much, Sam, for joining us here.
You're welcome.
Well, Sam Gishohi is the Business Development Manager at NIC Capital, joining us here to help us put those figures into perspective. This is the Trading Bell. Stay right here.
Hi, my name is Rachel. What does market turnover mean?
Market turnover is a reference to the amount of money that has changed hands during any trading day. So during a trading day, we have two things. We have volumes and turnover. Volumes is the number of shares. Turnover is how much those shares were worth. So it means that if shares worth 1 billion shillings were traded, both on the buying and selling, so you will have how much was traded on the sell side and how much was traded on the buy side in terms of Kenya shillings or US dollars, and that is what market turnover indicates.
Well, a very interesting historical perspective of the Nairobi Securities Exchange. And this marks the end of Trading Bell program for today. Many thanks indeed for joining us here. We look forward for the same company next week, same time right here on KBC Channel 1. My name is O'Brien Kimani. I always encourage to get in touch with us. Our SMS line is 22162. Always remember to start with the word biz, that is B-I-Z. My Twitter handle is @O'Brien Kimani. And of course, our Trading Bell Twitter handle is @The Trading Bell. Facebook page is The Trading Bell TV Show. You can always get in touch with us using any or all of these avenues. We'll see you again on Thursday. Until then, have yourself a peaceful night. But I'm taking you back to Broadcasting House. Good night.